You're staring at your July payslip, gross looks solid, then you hit the tax line. 47 cents of every dollar above $190 just vanished into thin air. So what did the 2026 budget actually change for people earning over $150? The headline cut saves $268. Identical whether you earn 50 grand or 500. $268. But the real budget is underneath. One move puts $175,000 into super. In a single year, another makes capital gains worse by $55,000 on one sale. And the trust loophole? $3.6 billion a year sheltered. It's closing. Let's start with the change most people got backwards. The government killed the 50% capital gains discount. From July 2027, that flat half off on long-term gains is gone, replaced with CPI, indexation of your cost base, then full tax on the adjusted gain. Sounds fair on paper, run the numbers, and it falls apart. Treasury published their own worked example. Buy an asset for $1 million. Sell it 5 years later for $1.5 million. Under the old system, your taxable gain was $250,000. Under the new system, after indexing by 2.5% annual inflation, it jumps to $368,000. That is $55,700 more in tax. Same asset, same profit, different rules. Scale that to a $500,000 gain on a Sydney investment property, and this stops being theoretical. Indexation only beats the old discount when your investment barely outpaces inflation. Basically, a dud. Anything growing above 3 to 4% in real terms pays more under the new model. If you've been building a long-term share portfolio, this is the change that hits you directly. Shares, decent property, growth ETFs, all on the wrong side now. There's a new floor too. 30% minimum tax on all capital gains, regardless of your marginal rate. Retiree selling a beach house on a low income? 30%. No exceptions unless you're on income support. If you already own the asset, anything accrued before July 2027 keeps the old treatment. The longer you've held it, the more is protected. And if you're buying a new build, you still get to pick between the old discount or the new indexation, which connects directly to the property changes coming later. But CGT isn't the move that saves the most cash right now. The concessional super cap just rose to $32,500. At the top bracket, salary sacrificing to that cap means 15% inside super versus 47% outside. 32 cents saved on every dollar you redirect. Max it out, and you keep roughly $10,400 that would have gone to the ATO. Solid. Predictable. Now forget the annual cap for a second. If your total super balance is under $500,000, the ATO lets you carry forward unused concessional cap space from the previous 5 years. Stack every missed year together. In 2026-27, that stacks to $175,000. One contribution. One financial year. Most people have no idea they're sitting on this. Current year's 32.5 plus 5 years of unused caps stretching back to 21-22. You just need to have not maxed those years out. Most people haven't. The ATO doesn't flag this for you. Picture this. You've been salary sacrificing $5,000 a year, leaving about $25,000 of cap space unused annually. You sell a property, or you land a big bonus. You funnel $175,000 straight into super in one hit. Even with Division 293 adding an extra 15% for earners above $250,000, your effective rate inside super is 30% versus 47% outside. On that full amount, the tax saving is roughly $29,750. 1 year. Completely legal. Those unused caps from 21, 22, they expire after this financial year. Use them or lose them. One ceiling to watch. If your super balance crosses $3 million, a new tax layer kicks in from this year. Extra 15% on earnings above that line. Near the threshold, the old maximised super advice might actually flip. 2 smaller ones to check off while you're inside myGov. Medicare levy, surcharge. Earn above $150,000 without private hospital cover, and you cop an extra 1 to 1.5% on top of the standard levy. On $200,000, that's up to $3,000 in avoidable tax. A basic compliant hospital policy often costs less than that. You're literally paying more to have no cover than to have it. And if you still carry a HECS debt, the government wiped 20% off every outstanding balance in early 2026, $16 billion erased nationally. The new repayment structure caps the top rate at 10% of repayment income. If you've been making voluntary repayments, recalculate. That cash might work harder inside Super. So Super shelters your income. CGT hits your growth. What about the people rooting everything through trusts? From July 2028, every distribution from a discretionary trust gets a 30% minimum tax. Family trusts have been a cornerstone of Australian tax planning for decades. The playbook was clean. Earn inside a trust, distribute to family members in low brackets. An adult child studying full-time, a spouse working part-time. Income that would have been taxed at 47 cents flowing out at close to zero. The government expects this single change to raise about $4.5 billion over 5 years. Something about this doesn't quite square though. The government says it targets the top end, but a 30% floor with no refund changes the picture. A uni student receives $50,000 from a family trust. Their actual marginal rate should be well below 30. They still pay 30. No refund on the gap. The trustee pays 30% upfront. Beneficiary gets a credit against their own return. Rate above 30? No change. Below 30, the excess doesn't come back. Exceptions exist for fixed trusts, super funds, charities, deceased estates, and primary production. The standard family discretionary trust used for income splitting? Not exempt. Some advisors are already restructuring into companies as an alternative. There's a 3-year rollover window from July 2027 to restructure without triggering capital gains. If you have a family trust, that runway has already started. This feeds directly into property. Negative gearing on established residential property is dead for new purchases. Any established home bought after budget night, the 12th of May 2026, can no longer offset rental losses against your wage income. You can still deduct against other rental income. You can carry losses forward, but the classic move, buying an older apartment, claiming a loss, and cutting your PAYG. Over. New builds still qualify for negative gearing. And remember the CGT carve-out? New build investors choose between the old 50% discount or indexation. The budget is funneling high earner property capital toward new construction. The stick and the carrot both point the same way. If you are planning to buy an established investment this year, the rental yield needs to carry itself now. Anything you own from before budget night is fully grandfathered. If you take one thing from this, it's the super carry forward. Up to $175,000 sheltered in a single year, and that window is shrinking. The most useful thing you can do this month is log into myGov and check your unused supercap space before the oldest years drop off. One screen, one number. That number could be worth $30,000. If your brain won't let go of stuff like this, subscribe and we'll keep pulling them apart.